allowance method for uncollectibles and how to estimate bad debt expense based on the percent of sales, percent of receivables, and aging of receivables. I think I might actually break down each of those estimation methods into their own video rather than cramming it all into this one, but we'll see. So we already talked about the direct write-off method. Now we're looking at the allowance method. So most companies will use the allowance method for measuring bad debts because it is GAAP approved and it does follow the matching principle. And so the reason that it follows the matching principle is because it'll record the bad debt expense in the same period that sales revenue were recorded. And we achieve this by introducing a new account, which is a contra asset account called Allowance for Bad Debts. And the allowance for bad debts is a contra account with its sister account being accounts receivable. And so the allowance for bad debts reduces accounts receivable, and then that presents on our financial statements the net realizable value. And so we have it coming up on a balance sheet, so I'm just going to hold that thought actually until we get there. So when we use the allowance method, we have this example of recording a bad debt expense. So at the end of the year, we're going to do an adjusting entry where we will estimate how much of our current accounts receivable will not be collected. And so you can see here that on December 31st, we've estimated that $80 of our 4,400 accounts receivable is not collectible. And so we debit bad debt expense and we credit allowance for bad debts. And so that's increasing the expense in the year that those revenues were generated. And then the allowance for bad debts is a contra account, which is going to reduce our asset of accounts receivable to show the net realizable value on our financial statements, which you can see in this slide. And so in our asset column, an outsider can look at this and see truly the company has 4,400 of accounts receivable, but they anticipate $80 will not be collected. So a more accurate anticipation of what we will receive is $4,320. And again, this might seem minor, but add 6 zeros behind all these numbers, and obviously that's more significant. So when we're using the allowance method, the allowance is established for the estimated uncollectible account. And so that happens where we debit the bad debt expense and credit the allowance for doubtful accounts, or allowance for bad debts, at the end of every year. So then when we actually do write off an uncollectible account, we no longer will debit bad debt expense. Instead, we're going to debit the allowance for bad debts. And so we can see here in this slide where we're doing a very similar thing to what we did in the direct write-off method, except now we are debiting allowance for bad debts and crediting accounts receivable. And so remember that allowance for bad debts is a contra asset. So by debiting it, we're decreasing the allowance for bad debts. And that makes sense because if at the beginning, or I guess we should say the end of last year, we anticipated $80 would not be paid off, and now we're actually saying, yep, this $25 will never be paid to us, we need to decrease the 80 by that 25. So now we're showing, as of today, we anticipate another $55 will not be paid off. And as far as how it appears on the balance sheet, you can see that the net realizable value stays the same because by completing the journal entry that we saw in the previous slide, we decreased the accounts receivable, but we also decreased the allowance for bad debts, which ends up showing or presenting the same net realizable value. So if a company writes off, if we're the company, so if our company writes off a customer's bad debt and then that customer happens to pay, just like the direct write-off method, we have to reinstate it and then show the cash collection. But instead of doing what we did in the direct write-off method with bad debt expense, we will debit accounts receivable, credit allowance for bad debts, and then show the cash collection in the next journal entry. So this slide is a summary of the two different methods, the direct write-off method and the allowance method. I would pause the video and write these down and make sure that you understand what the journal entries look like for both methods, and just have that to be able to reference back to. So in the allowance method, we have this adjusting entry at the end of the year where we're recording bad debt expense for the period. But how are we going to get this number, in this case $300? And so companies estimate bad debt expense based on their own past experience, the industry that they operate in, and what is common or average within that industry. And then they might also look at other things, just historical information and maybe, trends of what they're expecting to change, or if they're expecting to change their credit terms and hopefully that'll decrease their uncollectible account, then maybe they're going to combine that strategy with past experience to come up with a different bad debt expense estimation. But there's three methods to estimate uncollectibles using the allowance method. So we can use percent of sales, which is the income statement approach. We can use percent of receivables, which is a balance sheet approach, or aging of receivables, which is also a balance sheet approach. And I'm going to go ahead and stop this video and then do a separate videos for how we actually use these three different approaches.